Good evening. We begin our 2026 economic overview with the latest data on the National Holographic Map. Growth indicators remain strong across the Midwest.
The U.S. economy is once again at a critical turning point as investors, businesses, and households closely watch the Federal Reserve's next move on interest rates. After a series of rate cuts in late 2025, the biggest question dominating financial markets today is simple but powerful. Is the Fed preparing to cut interest rates again in 2026? Or will it pause and wait? Recent economic data, statements from Federal Reserve officials, and shifting market expectations suggest that the answer is far from straightforward. Where interest rates stand today at the end of 2025, the Federal Reserve delivered multiple rate cuts, reducing the federal funds rate to a range of 3.50% to 3.75%. These cuts marked a major shift from the aggressive tightening cycle that began in 2022 to fight inflation. The Fed justified these cuts by pointing to cooling inflation, slower economic growth, and early signs of weakness in the labor market. However, policymakers made it clear that further cuts would depend entirely on incoming economic data. As we move deeper into 2026, interest rates remain unchanged, but the debate inside the Fed is intensifying. Inflation, still the Fed's top priority, inflation remains the single most important factor guiding the Federal Reserve's decisions. While headline inflation has come down significantly from its 2022 peak, it is still hovering slightly above the Fed's 2% target. Core inflation, which excludes food and energy, remains stubborn in certain sectors such as housing, healthcare, and services. Fed Chair Jerome Powell has repeatedly emphasized that the central bank does not want to declare victory too early. Policymakers fear that cutting rates too quickly could reignite inflation, undoing years of hard-fought progress. For now, inflation data suggests stability, not urgency. That gives the Fed room to be patient. Labor market signals are flashing yellow. One of the strongest arguments for another rate cut is coming from the U.S. labor market. Although unemployment remains relatively low, job growth has slowed noticeably. Hiring in sectors such as manufacturing, logistics, and technology has weakened, and job openings are declining across the country. Federal Reserve Governor Michelle Bowman recently warned that the labor market is becoming more fragile than headline numbers suggest. She noted that if employment conditions deteriorate faster than expected, the Fed should be prepared to respond with additional rate cuts to prevent a sharper economic slowdown. Wage growth has also cooled, which reduces inflation pressure but raises concerns about consumer spending in the months ahead. Economic growth is losing momentum. U.S. economic growth remains positive, but momentum is fading. Consumer spending, the backbone of the U.S. economy, has slowed as households face higher credit card balances, tighter lending standards, and rising living costs. Business investment has also softened due to uncertainty over rates, global trade tensions, and weaker demand. Housing remains one of the most rate-sensitive sectors. Mortgage rates have declined slightly following last year's cuts, but affordability remains a major challenge. A further rate cut could help revive housing activity, but the Fed is cautious about stimulating demand too quickly. Deep division inside the Federal Reserve, one of the most important developments in 2026, is the growing disagreement within the Federal Reserve itself. Some policymakers believe the economy is slowing enough to justify at least one more rate cut this year. They argue that inflation is under control and that delaying action could increase recession risks. Others take a more conservative stance, warning that financial conditions have already eased significantly. Stock markets are strong, credit is flowing, and risk-taking is rising. These officials fear that cutting rates again could fuel asset bubbles and weaken the Fed's credibility. This internal split has made markets more volatile, as investors struggle to predict which side will ultimately shape policy. What Wall Street is expecting, market expectations remain sharply divided. Some investors are pricing in one rate cut later in 2026, particularly if job growth continues to weaken. Futures markets suggest growing bets on a cut in the second half of the year. However, major financial institutions like J.P. Morgan have taken a more hawkish view, arguing that the Fed may hold rates steady throughout 2026, and could even consider raising rates in 2027 if inflation proves persistent. This clash of expectations has kept bond yields fluctuating and the U.S. dollar under pressure. Political pressure and Fed independence. Another factor adding uncertainty is political pressure surrounding the Federal Reserve. Recent headlines involving legal and political scrutiny of Fed leadership have renewed concerns about central bank independence. While the Fed insists that policy decisions remain strictly data-driven, any perception of political influence can unsettle financial markets. Maintaining credibility and independence is critical, especially during periods of economic uncertainty. What could trigger the next rate cut? Several key factors could push the Fed toward another rate cut. A sharp rise in unemployment, a sustained slowdown in consumer spending, a financial market shock, or credit stress, clear evidence that inflation is firmly under control. On the other hand, the Fed will likely hold rates steady if inflation remains sticky or if economic growth stabilizes. Final outlook: cut or hold? As of today, the Federal Reserve appears to be in wait-and-see mode. The door to another rate cut is open, but it is not guaranteed. Policymakers want more evidence that inflation will continue to fall and that economic weakness is real, not temporary. For now, investors should prepare for volatility, mixed signals, and cautious messaging from the Fed.
Stay tuned for next U.S. Economy Update.